You've been lied to about candlesticks. Question for you. This is the perfect buying signal, perfect zone. Is it gonna go up from here? Is it this pattern, or this one, or this one? Most traders get it wrong. Candlesticks only tell half the story, and if you're relying on them alone, you're setting yourself up for failure. I just made over $2,000 on this trade this morning, and it all started with this common candlestick pattern right here. But this indicator right here is really what confirmed that it was time to jump into the trade. You need to use this every time you enter into a trade, otherwise you're likely to continue creating unnecessary losses. In this video, I'm gonna walk you through the 3 simple steps that will completely change how you approach trading candlestick patterns. First, I'm gonna show you how to actually read candlesticks the right way so you stop misreading signals that were really never entries in the first place. Then I'll break down to you the 6 most effective candlestick patterns I found over the years, ones that I still use every single week. And finally, I'll reveal the indicator combo that I use to filter out fake signals and confirm my entries with confidence that will stop you jumping into false signals and creating more losing trades. If you're entering a trade every time a setup appears, you're going to lose money. I know you probably want to skip ahead to the indicator that confirms whether a trade is worth taking or not, but if you don't build the solid foundation first, it won't make sense anyway. And worse, you'll still end up hesitating or jumping in too early, creating unnecessary losses. Candlestick patterns are just as important, and so let me show you how to properly read and use them first. Now, prior to candlestick charts, we had just simple line charts that is essentially just connecting 2 dots or more. Now, instead, candlesticks give us 4 points of data, and you can see comparing these 2 charts, there's a lot of data down here that you're missing in the line chart. That's why candlestick charts are so important. Candlestick charts give you 4 points of data. They give you the closing price, the opening price, and the extreme low and high of that candlestick. A green candlestick signifies that the price went up over the candlestick, and a red signifies that it went down. And then what you have outside of the body of the candlestick is you have what's called a wick. And essentially this just shows you where the price moved to the extreme high before it ended up closing or opening at the price the candlestick closed at. And then candlesticks can also represent different time periods. One candlestick can be changed to represent any amount of time or volume, but the idea is that it represents a certain amount of data. A lot of the time, and most commonly, it's a time-based chart where one candlestick can represent 1 minute, 10 minutes, 30 minutes, an hour, a day, a week. And what this allows you to do is create all these different patterns in those different time frames. So even if you see a pattern on a 1-minute chart, it may play out a specific move on a 1-minute chart, but there could be a completely different pattern on a 30-minute chart. But all the candlestick patterns and everything that we're gonna go over can be used on any market or time frame, because what you're doing is you're reading the candlesticks, and candlesticks represent the price movement of that asset you're looking at. And it's essentially the raw data of where the buyers and sellers are. And so no matter what you're trading, it's representing that raw data. And all these patterns are common indicators of what that raw data is really telling you could happen in the market. Now, most traders know what candlesticks are, but almost none of them know how to actually use them correctly. And that's why I'm building up to the tool that I use to confirm what really makes a candlestick pattern a signal and not just noise to fake you out. Now, make sure to remember these 4 key points in the candlestick, because one of the tools that I'm going to show you later is entirely based on this data. And it's extremely powerful for helping you confirm candlestick entries. Now let's go over some candlestick anatomy. The first off being big versus small bodies. and what this means. A big body represents dominance from either the buyers or sellers. This green candlestick right here, opening here, moving all the way up here and closing, shows a lot of buying pressure versus something smaller like this, where the sellers, it opens up here, moves down and closes here, is small, representing not that much movement from the sellers. This is a trade right here where I made over $2,000. And yeah, this candlestick right here was a really big clue to jump in on the trade, but wasn't the overall reason of why I took this trade. The real confirmation came from something else. Something that I'll show you later that helps me confirm whether a candlestick pattern is worth entering in or not. The big candlesticks matter, but only when they align with the right signals. Now, the second most important structure you'll see is candlesticks with large wicks. This candlestick right here is showing you a potential for a reversal because the price of this candlestick opened up here, pushed up higher, and then sold off and closed a tiny bit above where it was. But essentially what this candlestick is telling you is that this overall price was rejected. And so it could signal a potential for a reversal. Same thing with this candlestick. The only difference is a slight difference in the open price of the candlestick and the close price. It's just flipped. And then this candlestick pattern right here is the same thing, but in reverse, where the price opened up here, pushed a little higher, sold off hard, but then that hard sell-off there was reversed and it closed somewhere there. Again, this is showing you a potential for a reversal to come in the following candlesticks. This is why knowing that data versus just a line chart is extremely important. Now, these big wicks are critical for entering into potential trades. This trade right here, this big reversal candlestick with a huge wick, was the final confirmation to jump on this trade that made over $1,000 in just a few minutes, but only when they appear in the right context. In a minute, I'm going to show you how to tell when these big reversal wicked candlesticks are actually important and when they're just making noise trying to trap you. Now, the last one of these is when there is a small body and equal wicks on above or below the body of the candlestick. What these do is they show classic indecision. And the whole reason of this is because for either of these three candlestick patterns, the price essentially opened up somewhere in the middle of the candlestick, pushed one direction, reversed the other direction, and then reversed again, closing near the middle of the candlestick. With this one right here, it specifically opened and closed at the exact same price, showing no movement. But it's really key to know that because what this does is it shows indecision, and these are called dojis. But here's the problem. Dojis constantly fake people out or just get them in bad trades. So in a minute, I'll show you how to read them correctly and use them to your advantage. But first, we need to talk about multi-candlestick patterns. Now let's jump into the top 6 candlestick patterns I've used over the years. These are common candlestick patterns that you will see that, based on their structure and the market psychology of what the data is showing you, commonly will play out in a specific manner. Now, the first one of these candlestick patterns is called the engulfing candlestick pattern. It's just a 2 candlestick pattern, but what it signifies is that it's a reversal pattern where the chart is coming down, and if you see this pattern, it will signify that it's likely that the price reverses to the upside. The idea of how this works is you have a bearish candlestick that is engulfed by a bullish candlestick right after it, where the open of this candlestick is lower than the low of the previous candlestick and the close of it is higher than the high of the bearish candlestick. The whole idea is it is a massive reversal happening where it completely blows out the previous candlestick. And this can happen on the flip side for the bearish version too, where a smaller bullish candlestick is engulfed by a big bearish candlestick. And again, the idea is that it's a reversal candlestick and likely the market is going to reverse after this. And this is a great confirmation for an entry, just like the trades I showed earlier. But again, you don't want to just blindly be using it by itself. The next one of these patterns is called a pin bar candlestick. This is where the importance of wicks comes into play. What this can help us do is it's another reversal candlestick pattern, but the idea is that you have a big bullish candlestick followed by what's called this reversal candlestick. This large wick is showing us that the price tried to continue higher and was rejected. It's showing you a flip in the momentum of the market that this is representing. The price was previously moving higher, and a topping pattern is gonna flip the price of the market. And this candlestick here is showing that. And followed by it, to complete this pattern, is a nice bearish reversal candlestick. After this, the idea is that this is gonna reverse lower, and it's a confirmation that you can use to enter into a trade. Same thing goes for the bullish version, where it's coming down, reversing in a big way, and it's indicating that the market could continue higher, reversing that trend that it was in. This is how you can start to read the market like a book. You can start to use these patterns and slowly build upon them, connecting them so you can eventually read a whole stock chart clearly. This next candlestick pattern is called a 3-line strike pattern. What it's showing you is there is a clean, methodical uptrend in the market, and then it is broken and reversed very rapidly by this huge engulfing candlestick that engulfs multiple of the candlesticks before it. It shows you a massive switch in momentum and a massive increase in momentum in the other direction. And so how you can use this is, again, bullish or bearish side, is that the market is switching from a slow methodical move lower to a rapid move higher. Buyers are really stepping in, wanting to buy at this level, which is likely to continue to push the market higher after this pattern. Again, these patterns are super powerful, but you have to stack them with other indicators. Now that we can start to get into some larger patterns, and a flag pattern is a key pattern that will help us understand how to read dojis. And so how this pattern works is it's a continuation pattern. The idea is the market moves up and goes sideways. It essentially creates a flag. The idea with this is the market's had a really strong move higher, and it's now just taking a breather. It's coming to a point where it just needs to catch its breath. It's a little overextended, and this pattern often signifies a continuation, that it could continue higher, that this momentum that it had before is just taking a pause, and it's gonna come back in and push the market higher. But what will often happen is you'll start to see dojis here when it flags out. And dojis are okay if there's a couple of them, but once there becomes too many, you can start to get trapped. If we flip over to the bearish version here, it's the same thing to the flip side, where we have a strong momentum to the downside, but then it starts to go sideways. And the key to knowing if this is really going to continue, or it could do what I call a failed breakout, where it attempts to break lower and the market actually reverses, trapping people and making this pattern cause a false signal, is when you start to get a lot of dojis stacking up. When you start to see the market just sit there for too long, that's when the momentum has really just dried up and it's not taking a brief break. The idea with this pattern is it has a large momentum move and it just takes a quick break before it continues higher. If it starts to take too long of a break like this, that's when you want to stay out. That's when the dojis can really start to give you some insight that there is too much indecision in the market, and it's likely to not have a clear move in either direction that is easy to trade, and you should stay out of the market. I used to fall for this all the time myself. This pattern right here looks really clean, right? But this can easily turn into what I call a failed breakout, where the market pushes lower and then immediately flips on you, reversing higher. There's one key missing step that is really good to know to tell the difference between if it's actually gonna break out or do a fake out. And we're almost to where we can talk about that, but I wanna first talk about a few big picture candlestick patterns that are really gonna tie this all together for you. The first one of those is a pullback pattern. This is a super simple market structure pattern, but it'll start to connect some of these dots for you. The whole idea with this is here's the bearish version, which means the market's gonna reverse, is the market's coming up in a nice solid trend higher. It pulls back and then it pushes one more time up. But then what happens is you'll notice we get an engulfing candlestick pattern right here. And what that signals is it's putting in a lower high right here. This swing, if you kind of just think about it like a line chart now, is the market made a high here, pulled back, made one more high here, and now is pushing lower. That high is lower than this one. And in the big picture structure idea of the market, that is a big reversal signal. If you couple it with this engulfing candlestick pattern, this starts to become a powerful signal. As soon as this engulfing candlestick pattern here is formed, you can use that as a confirmation to enter in on a trade with the idea that the market is going to push lower based off of that. Same thing goes for the bullish side. But you can see on the flip side, same thing. But you could have a different candlestick pattern, making this, you can even call it a double bottom. This is how you start to look at candlesticks and create larger picture structures in the market that can signal key areas that you want to pay attention to. So you can start to see this pattern and the flag pattern are very similar in a lot of ways. How do you know when a pattern is going to either continue or when it's going to fake you out in the opposite direction? In reverse, which is why in a minute we're going to go over how do you know when it's actually the right time to jump into a trade versus when it's important to stay out so you don't actually get trapped and lose money. Now before we go further, if you want a downloadable guide that goes through all of these candlestick patterns, I've created a free 14-page PDF that you can download for free in the description of this video, and it will go into way more patterns with way more detail that I highly recommend you get. You can download it in the description of this video or via this QR code. Now the last one of these is called the head and shoulders pattern. It's a big key reversal pattern, but again, it's really powerful when you couple it with the indicators that really confirm whether an area is worth taking a trade or not. The whole idea of how this works is it's looking at the big picture structure of the market. It's essentially looking at the swings of the market where it's making in an uptrend, it's making higher highs and higher lows consistently, and then all of a sudden it switches to making lower lows and then lower highs. What you'll start to notice about these patterns is that they're very simple. You do not need complex patterns to understand what the market is doing. And keys with this head and shoulders pattern is on the bullish side where this is gonna signal, we're gonna make a reversal to the upside. This key is you want this final extreme low that it makes to be strong and then it to reverse quickly. Essentially, it's showing you the market got overextended, accelerated to this side, and then buyers came in a big way and pushed it to the upside. This final pullback here, and really adding this pullback pattern that we talked about earlier, essentially what it's doing is it's showing you, it's giving you the confirmation of, okay, is this gonna just continue lower? Because, well, it could just continue making lower lows and lower highs here, but once it creates this bottom here and really starts to form this candle and this candle, that's when you can confidently say that, okay, it's starting to shift. And that's how you use these patterns to understand what the market is gonna do. Okay, now we can get to the indicators that separate the false signals from the real ones. These are the two key tools that I use to confirm if a candlestick pattern is really worth following. Without this, you're probably just flipping a coin following these candlestick patterns. Now, if you don't have access to high quality trading charts like this, I use NinjaTrader for all my chart analysis and trading. It's what I rely on to spot these candlestick patterns clearly. You could check it out for free via this QR code or in the description of this video. Now, the first one of these is taking into account the big picture context of the market. And the way I do that is look at the key swings that the market is having. It may seem really simple, but the way I do this has a trick to it. And so what you want to be doing is you want to be looking at the key areas and extremes where the market is reversing, either on the upper end of where it keeps bouncing or on the lower end. You can see the extremes of the market make it way more likely for it to reverse. Because if you try and capture every single move in the market, all these little reversals in here, it's really hard to know what the market's going to do at that point. But if you wait for the market to come up to a point where it's overextended, it hits an area where it's previously bounced and reversed off of multiple times, it makes it way more likely to do that again. It's essentially telling you that it's at an overextended location and it likely will reverse to the downside. This can happen on the flip side as well. And another tool you can use is actually a trend line for this. You can see here, if I try and just draw a zone, it kind of works, but it's not really bouncing off of that zone. Instead, it's bouncing off of this trend line that I can draw off of these two swings, this one again, and you can see here, it came and bounced off of this a fourth time after it made an extreme move to the downside. And I've actually created an indicator in NinjaTrader that will draw these key reversal zones for you. And so as a beginner, when you're just getting used to understanding where the key areas in the market are to pay attention to, this indicator will drastically help you pay attention to the right resistance and support zones that make it way more likely for you to know where to bet the market is going to go a certain direction. And you can download that for free in the description of the video as well. And the last most important thing here is this indicator that helps you identify when the market is overextended to one direction, making it likely to reverse back the other direction in a big way. This indicator draws these green or red lines based on if the market is overextended. And so how you can use this is coupling it with candlestick patterns, bigger trend lines, or support or resistance zones. And it's likely that if you combine this with a market being pushed up, you're at a resistance level and it pushes back lower, the market will reverse in that other direction. And you can see here, all these green lines that it has saying that it's overextended, the market pushed all the way back, giving all this move back up. And so if you're able to capture that move, that would be a massive reversal. Same thing on the flip side. It said, okay, it's super overextended to the downside. It needs to switch back to the upside. Took a little while, but it eventually reversed this whole move back up. And now currently right now where the market is, today it had a big move up. This said it was overextended, reversed back lower, and now it's making another push higher, showing that it's overextended and it's actually coming into this really big picture trend line right here, this upwards resistance zone where it's likely to shift lower. And so what I'm going to do now is I'm going to sit and watch this and wait to see if I get a candlestick formation for me. And so you can get this indicator in the description below this video as well for free. I highly recommend getting it. It will really help you drastically know when you're in a key area of opportunity. Otherwise, it's really likely that you won't know when you're in a good spot and you're likely to get in a bad signal that is going to lose. And so if I pull up that trade where I made $2,000 in one swing, let's answer our last few questions. Now, this is where everything comes together, and you'll see why here in a second. So the first thing is I'm looking for those two big key indicators. One is this market has come up to this resistance zone and then it's come up very quickly. I don't have that indicator that shows you that it's overextended here with those lines to the and bars to the side, but you can pretty much see here that that's what's going on. It's moved up quickly, so it's overextended in one direction. And so what we want to do is how we wait and figure out if this is going to be a breakout or a failed breakout is a lot of the times is you can wait and see what the pullback does. This breaks out of the previous major swing high that the market had before. And so a lot of times people might jump in thinking that that's going to be a breakout, and instead it fakes them out. And so the way to know if that's going to happen is if the market is overextended into that level. The market likes to move in clean, methodical movements. And if instead it comes up clean, methodical, and then shoots up into this level like this, like it's done here, is it's way more likely to cause a fake out and reverse back lower. And so that's the key to knowing if something's more likely to do a failed breakout or actually break out and continue higher. And then the last thing here is once it does that fake out, what I'm looking for is that pullback pattern to happen. That's kind of where you start to zoom in and figure out, okay, where do I actually want to enter in on this trade? And what did that for me was seeing that it essentially had an engulfing pattern here, pushed lower, and then it had a pullback pattern here where the market tried to go higher, but you can see this wick right here where the market pushed up and closed lower with a bearish candlestick. And then after that candlestick, it had a massive bearish candlestick. And when that one closed, I put in an order right below that candlestick to bet that the market was going to go lower. And then I put my stop loss initially above this swing high here because I think that I want to give the market room to play out, but if it comes all the way up here, it could continue to keep going lower. Sometimes the market goes down really quickly like this. Sometimes it has to play around a little while. And so that's how you know if a candlestick is just noise or it's an actual entry signal. It's when you start to, you look at the big picture and then you start to zoom in slowly. You only want to use it as the final confirmation to jump in. You don't want to just randomly be looking for big candlesticks or candlestick patterns in the middle of a move. You want to be looking at them at the extremes. And then from there, the market moved very quickly and easily in my direction, and I was able to close out with a big profit. And so make sure to get that free 14-page candlestick PDF guide in the description below. And as well, you'll find those free custom indicator tools down there as well. And if you really want to learn more about this strategy that I've briefly touched on and how I use these patterns to consistently execute trades, what time frames I use, what charts I actually trade on, check out this full course right here where I go step by step through everything you need to know. It'll build on this foundation that you've started to learn already.